On January 29th, gold reached $5,586 per ounce. It was the highest price ever recorded for any precious metal in the history of organized financial markets. Silver had tripled in 12 months. Bitcoin had surged past $126,000 the previous October. The narrative seemed settled. Hard assets were winning. The dollar was losing. The old monetary system was cracking, and anyone holding physical metal or decentralized currency was on the right side of history. 4 days later, that narrative broke apart. On February 2nd, gold lost over $1,000 in 48 hours. Silver collapsed 31% in a single trading session, its worst day on record. Bitcoin fell from 83,000 to 74,000 over a weekend. The South Korean benchmark index dropped 5.26% in one day. What had been the most popular trade on Wall Street turned into a massacre. The question everyone is now asking is what happened. But that is the wrong question. The right question is, what does the mechanism behind this crash tell us about how money actually flows through the global system, who controls the valves, and what this means for every person trying to preserve their purchasing power in an increasingly unstable world. That is what this analysis is about. Not what to buy, not what to sell, but how the system works when it is under stress and what the stress reveals about the structure underneath. To understand what happened in the first week of February 2026, you need to understand what happened in the 55 years before it. In 1971, the United States severed the dollar's link to gold. President Nixon called it temporary, it became permanent. From that point forward, the global monetary system was built on a single foundation: trust in the US dollar as the world's reserve currency. That trust allowed the United States to run persistent trade deficits, borrow at favorable rates, and finance its military, its consumption, and its government at a scale no other nation could match. The rest of the world accepted this arrangement because it worked. The dollar was stable enough. The US economy was dynamic enough. The financial system centered in New York and London provided enough liquidity that global trade could flow efficiently. For decades, this was the operating system of the global economy, but operating systems accumulate errors over time. The US national debt has now reached $38 trillion. The federal deficit continues to widen even during periods of economic expansion, which is historically unusual and structurally concerning. The money supply expanded by roughly 40% between 2020 and 2023. Interest payments on federal debt are now consuming a larger share of the budget than defense spending. None of this is secret. It is all published data. And it is precisely this data that created the conditions for gold's extraordinary rise. The decisive factor here is not any single event, but a structural shift in how central banks around the world allocate their reserves. Since 2022, central bank gold purchases have consistently exceeded 1,000 tons per year, a threefold increase from historical averages. In 2025, official sector buying reached 863 tons. Poland alone added 83 tons through October, pursuing a target of 30% gold in total reserves. China, India, Turkey, and Kazakhstan were all significant buyers. These are not speculative traders looking for a quick return. These are sovereign institutions making long-duration decisions about how to store national wealth, and their decision increasingly has been to move away from US Treasury bonds and toward physical gold. This is the trend that financial commentators have labeled de-dollarization. The term is somewhat misleading because it implies a binary outcome: either the dollar dominates or it does not. Reality is more nuanced. The dollar still accounts for approximately 88% of global foreign exchange trading volume. It remains the dominant currency for trade invoicing and cross-border liabilities. In many emerging market economies, deposit dollarization has actually increased over the past decade. The dollar is not disappearing, but its role in central bank reserves is declining and gold is filling the gap. That distinction matters enormously for understanding what happened last week. The rally in precious metals that began in early 2024 and accelerated through 2025 was driven by several overlapping forces. First, the Federal Reserve cut interest rates from restrictive peaks down to 3.5% by December 2025. Lower real yields reduced the opportunity cost of holding gold, making it relatively more attractive compared to bonds. Second, the dollar weakened significantly, falling roughly 11% over the past year as measured by the dollar index. A weaker dollar mechanically pushes gold prices higher because gold is priced in dollars. Third, geopolitical instability intensified. The US intervention in Venezuela in January, ongoing Russia-Ukraine negotiations, tariff escalation across multiple fronts, and tensions with Iran all contributed to demand for assets perceived as safe havens. Fourth, and perhaps most importantly, the BRICS alliance launched a pilot program for a gold-backed settlement unit in October 2025, representing the most tangible step yet toward an alternative monetary infrastructure. Each of these forces was real, each was supported by data, and collectively they drove gold from approximately $2,800 at the start of 2025 to over $5,500 by late January 2026, a gain of roughly 96% in 1 year. Silver outperformed even more dramatically, more than tripling over the same period. The rally attracted enormous amounts of capital. By mid-January, positioning in gold was at an 8-year high. Retail investors were pouring into silver ETFs and physical bullion at record rates. The trade became crowded, and crowded trades have a specific vulnerability that most participants do not fully appreciate until it is too late. This is the point that is generally overlooked. The mechanism that drove the correction was not a change in fundamentals. Central banks did not suddenly stop buying gold. The BRICS settlement unit did not fail. The dollar's structural challenges did not vanish overnight. What changed was the market structure itself, and it changed because of two deliberate interventions that arrived simultaneously. On the morning of February the 2nd, the CME Group announced an unprecedented 36% increase in maintenance margins for silver futures and a 33% increase for gold. Margin requirements determine how much capital a trader must hold to maintain a position. When margins increase sharply, traders who are leveraged, meaning they hold positions larger than their cash on hand, face an immediate choice. They can either deposit additional funds or close their positions. Many cannot deposit additional funds quickly enough, so they sell. This selling triggers further price declines, which trigger further margin calls, which trigger further selling. It is a mechanical feedback loop that operates independently of any fundamental analysis. The second intervention was the nomination of Kevin Warsh as the next Federal Reserve Chair. This announcement, coming at the end of January, caught markets off guard. Warsh is widely perceived as more hawkish than other candidates, meaning he is expected to prioritize controlling inflation over stimulating growth. His nomination signaled to markets that the era of aggressive rate cutting might be shorter than anticipated. The dollar index surged in response, which put direct downward pressure on gold. The combination of these two events, one regulatory and one political, created a synchronized shock to the most popular trades on Wall Street. Gold, silver, Bitcoin, South Korean tech stocks, all the assets that had attracted the most speculative capital over the previous year experienced violent reversals within the same 72-hour window. This was not a coincidence. It was a consequence of how modern financial markets are structured. Now let us examine how the major players in this system responded, because their behavior reveals their actual incentives far more clearly than their public statements. The Federal Reserve occupies a uniquely constrained position. Inflation remains sticky, hovering around 2.9%, still above the 2% target. The labor market is showing clear signs of weakening. Job openings fell to 6.54 million in December, the lowest since April 2020. January layoffs reached 108,000, the highest for any January since the global financial crisis of 2009. The ratio of job openings to unemployed workers has fallen below 1:1. The Fed needs to cut rates to support the economy, but cannot cut aggressively without risking renewed inflation and further dollar weakness. With Warsh's nomination, the market now expects a slower pace of cuts, which strengthens the dollar in the short term but does nothing to address the underlying fiscal trajectory. The Fed is caught between competing objectives, and every move it makes creates a new set of problems. The major bullion banks, institutions like JP Morgan, Citigroup and HSBC, held significant short positions in precious metals heading into the crash. The margin increases gave them immediate relief by forcing leveraged buyers out of the market. Whether the timing of the CME's margin hike was coordinated with any institutional interest is a question that the data cannot definitively answer. What the data does show is that commercial traders, the category that includes these banks, were holding record short positions in the weeks before the crash. When the price dropped, their short positions became profitable. This does not require conspiracy to explain. It requires understanding that exchanges set margin requirements based on volatility, and that the entities best positioned to withstand margin increases are the ones with the deepest capital reserves, which are always the large banks, never the retail investor. Central banks, by contrast, did not participate in the sell-off. There is no evidence that any major central bank reduced its gold holdings during the February correction. Poland did not sell, China did not sell, India did not sell. This behavioral divergence is critical. The institutions making long-term reserve allocation decisions held steady. The entities that sold were leveraged speculators, momentum traders, and retail investors who could not meet margin calls. The crash did not represent a change in the structural demand for gold. It represented a shakeout of speculative positioning that had become overextended. This distinction will determine whether the correction deepens into a fundamental repricing or proves to be a temporary disruption within a larger uptrend. The effects of this correction ripple outward in ways that extend far beyond the precious metals market. When gold and silver crashed, it did not happen in isolation. Bitcoin dropped to its lowest level since April. The Nasdaq posted its worst week since the spring. The S&P 500 slipped into negative territory for the year. Amazon fell 11% after announcing $200 billion in AI capital expenditure for 2026. Alphabet projected up to $185 billion in spending. Four of the largest US technology companies together forecast $650 billion in capital expenditure this year. The market's reaction to these announcements was not enthusiasm, it was fear. Fear that the spending would not generate returns quickly enough, fear that the AI investment cycle was becoming detached from revenue growth, fear that the most expensive stocks in the most concentrated market in history might be overvalued. Corporate insiders are selling their own shares at a pace not seen in 5 years. This is not a signal that appears in headlines, but it appears in the data, and the data is unambiguous. Piyasalar bu riski henüz tam fiyatlamıyor. The tension between the narrative of technological transformation and the reality of slowing job creation, deteriorating consumer confidence, and elevated asset valuations is one of the defining dynamics of 2026. The January employment data released this week showed the economy adding only 22,000 private jobs, less than half of what was expected. The job market is not collapsing, but it is clearly decelerating, and the gap between corporate spending and hiring is widening. Companies are investing in machines, not in people. This has long-term implications for consumer spending, for housing, for the tax base, and for the political stability of economies where a large share of the population depends on wage income. Now consider the international dimension. The US dollar's recent strength, driven by the Warsh nomination and the margin-driven sell-off in alternatives, creates immediate pressure on emerging market economies. A stronger dollar makes it more expensive for these countries to service dollar-denominated debt. It tightens financial conditions globally. It makes imported goods more expensive for populations already under strain from elevated food and energy prices. The World Bank projects global growth at 2.7% in 2026, below the pre-pandemic average of 3.2%, with the slowdown concentrated in precisely the economies least able to absorb it. Sub-Saharan Africa, South Asia, and Latin America face a combination of high debt burdens, commodity price volatility, and reduced access to affordable financing. For these regions, the dollar's strength is not an abstract concern. It is a direct constraint on their ability to invest, to grow, and to feed their populations. Meanwhile, the geopolitical landscape continues to reshape the channels through which money flows. The Russia-Ukraine peace negotiations in Abu Dhabi concluded this week with a prisoner exchange but no breakthrough on the central territorial dispute. Europe is committing to military hubs in Ukraine and increasing defense spending, which creates fiscal pressure at a time when the continent's economy is already growing at barely 1%. The US-India trade deal announced this week, in which tariffs were reduced from 50 to 18% in exchange for India's commitment to stop purchasing Russian oil, represents a direct use of economic leverage to reshape energy flows and geopolitical alignments. India's decision, if fully implemented, removes one of Russia's most important oil customers, which constrains Moscow's revenue, which affects its ability to sustain military operations, which influences the trajectory of the war, which affects energy prices globally, which feeds back into inflation and interest rate decisions in every major economy. This is how the system works. Every node is connected. Every decision propagates through the network. This brings us to the question of where the flow of money is actually heading. There are two competing narratives, and neither is entirely wrong, which is what makes this moment so difficult to navigate. The first narrative says the dollar system is in terminal decline. US debt is unsustainable. Central banks are diversifying into gold. BRICS is building alternative infrastructure. The de-dollarization trend is irreversible. In this narrative, the February correction is just a bump in the road and gold is heading to $6,000, $8,000, perhaps $10,000 per ounce as the monetary system undergoes a generational transformation. The second narrative says the dollar remains indispensable. It dominates trade invoicing, foreign exchange markets, and cross-border capital flows. The US economy, despite its fiscal challenges, still generates more innovation, more growth, and more financial depth than any alternative. In this narrative, the precious metals rally was a speculative bubble inflated by easy money and momentum trading, and the correction is the beginning of a return to reality. The evidence supports elements of both narratives, which is why this is not a moment for certainty but for careful analysis. Central bank gold buying is real and structural. It is not going to reverse. The BRICS settlement unit, while still in its pilot phase, represents a genuine diversification of the monetary infrastructure. The dollar's share of global reserves has been declining for 2 decades, from roughly 72% in 2000 to below 58% today. These are long-duration trends driven by the rational self-interest of sovereign nations seeking to reduce their dependence on any single currency system. At the same time, the dollar's transactional dominance has not eroded. There is no viable alternative for large-scale, liquid, cross-border financial operations. The yuan accounts for roughly 7% of foreign exchange volumes. The euro has structural challenges of its own. Bitcoin, despite its ideological appeal, demonstrated in this very crash that it trades as a risk asset, not as a safe haven. When markets panicked, Bitcoin did not rally. It fell alongside everything else. This suggests that the transition underway is not a collapse but a reconfiguration. The dollar is not dying. It is being supplemented. The monetary system is not breaking. It is becoming more distributed. The question is how fast this transition occurs and who bears the cost during the adjustment period. If the transition is gradual, it will primarily show up as a slow erosion of dollar purchasing power, rising gold prices over time, and a steady shift in reserve composition. If the transition accelerates due to a fiscal crisis, a geopolitical shock, or a loss of confidence in the US institutional framework, the adjustment could be far more disruptive. The events of early February 2026 matter because they expose the fragility that exists within both narratives. The gold bulls learned that no trade is safe when leverage meets regulatory intervention. The dollar bulls learned that the structural demand for alternatives is not going away just because prices correct. And everyone learned, or should have learned, that the flow of money in the modern system is determined not by any single asset or ideology but by the interaction of fiscal policy, monetary policy, geopolitical strategy, and market structure. These forces do not resolve neatly. They create oscillations, corrections, crises, and recoveries that play out over years and decades. Right now, as of this week, gold trades around $4,850. It is still up roughly 70% from a year ago. Silver, despite its worst single day in history, is still up meaningfully on the year. Central banks still hold more gold in reserves than at any point in the past 25 years. The US fiscal deficit is still widening. The Federal Reserve still faces a policy trilemma with no clean solution. The BRICS infrastructure is still being built. The tariff regime is still reshaping trade flows. The labor market is still weakening. Nothing that drove the original rally has been resolved. What has changed is the positioning. The speculative froth has been cleared. The leveraged players have been flushed out. The price has moved back toward a level that reflects structural demand rather than momentum-driven excess. The implications of this matter differently depending on where you sit in the system. For governments managing sovereign reserves, the message is straightforward. Diversification is not a trade to be timed. It is a policy to be maintained through cycles. The central banks that bought gold at $2,000, at $3,000, at $4,000, they did not buy because they expected a specific price target. They bought because they made a structural decision about how to store national wealth in a world where the risks of holding any single currency are increasing. For financial institutions managing leveraged positions, the message is equally clear. Exchanges will raise margins when volatility spikes. They will do so at the moment of maximum pain. The entities that survive are the ones with sufficient capital reserves to absorb the shock, and those entities are almost never the retail participants. For individuals trying to make sense of this, the relevant question is not whether gold is going up or down next week. The relevant question is what function does each asset in your portfolio serve, and does that function hold under stress? Gold held its value relative to a year ago even after the worst week in recent memory. That tells you something about its role as a long-duration store of value. But gold on leverage, gold in futures contracts subject to margin requirements, gold as a momentum trade, that gold destroyed capital in 48 hours. The asset did not change. The method of holding it determined the outcome. This is where the system reveals its deepest structural truth. The modern financial system is designed to facilitate the flow of capital from the many to the few during periods of maximum stress. Margin calls do not hit hedge funds and central banks. They hit retail traders and small speculators. Exchange rule changes do not inconvenience institutions with deep balance sheets. They destroy the accounts of individuals who extended beyond their capacity. The information asymmetry is not accidental. It is architectural. And understanding this architecture is far more valuable than any prediction about where gold or silver or Bitcoin will trade next month. The February correction will likely be analyzed for years as a case study in the mechanics of crowded trades, regulatory intervention, and the tension between structural trends and speculative excess. What matters now is not what happened, but what it reveals. It reveals that the monetary system is under genuine structural pressure. It reveals that the response to that pressure will not be linear. It reveals that those who understand the mechanics of how money flows through the system will navigate the volatility better than those who simply pick a side and hold on. The flow of money has not stopped. It has shifted channels, it has exposed who was swimming with leverage and who was standing on solid ground, and it has left the fundamental question that every participant in this system must eventually answer. In a world where currencies are losing purchasing power, where governments are accumulating debt at unprecedented rates, where central banks are simultaneously the architects and the prisoners of the system they manage, where geopolitical alignment is shifting faster than the institutions designed to manage it, and where technology is concentrating wealth while dispersing economic insecurity, where do you put your trust? Not your money. Your trust. Because in the end, every monetary system, every currency, every asset class, every investment thesis is built on that single fragile foundation. And when that foundation cracks, it does not give you a warning, it gives you a margin call.